Hey guys, welcome back to another episode. In this video we will be going through our very simple yet profitable, the best engulfing trading indicator and strategy. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. And don't forget to share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. Have you ever tried to trade engulfing bars? Or maybe you are currently doing so. So, how has that been working out for you so far? The engulfing candlestick pattern is one of my favorite reversal patterns in forex and stock market. Navigating the market to find consistent profits is all about following the clues it leaves behind. Of course, when I say clues, I'm referring to the formations that price action leaves in its wake. One such formation is that of the engulfing bar. They don't come around often, but when they do, it's important that you know how to take full advantage of the profit potential. In this video, you will learn what an engulfing pattern is and how you can trade it for huge profits. You will also learn the characteristics that must be present to make it tradable. Knowing these things will help you maximize your profit potential and minimize your risk. And now, what is the engulfing pattern? Engulfing candles tend to signal a reversal of the current trend in the market. This specific pattern involves two candles, with the latter candle engulfs the entire body of the candle before it. Although an engulfing bar is technically valid if it engulfs just the immediate bar prior to it. Note that the more prior bars that this bar engulfs, the stronger it gets. Types of engulfing patterns. There are two engulfing candle patterns: bullish engulfing and the bearish engulfing pattern. First, bullish engulfing pattern. The bullish engulfing pattern is a two-candle reversal pattern. The second candle completely engulfs the real body of the first one, without regard to the length of the tail shadows. This pattern appears in a downtrend and is a combination of one red candle followed by a larger blue candle. On the second day of the pattern, the price opens lower than the previous low, yet buying pressure pushes the price up to a higher level than the previous high, culminating in an obvious win for the buyers. Interpretation. Price action must show a clear downtrend when the bullish pattern appears. The large bullish candle shows that buyers are piling into the market aggressively, and this provides the initial bias for further upward momentum. Traders will then look for confirmation that the trend is indeed turning around by making use of indicators, key levels of support and resistance, and subsequent price action after the engulfing pattern. Second, bearish engulfing pattern. The bearish engulfing pattern is simply the opposite of the bullish pattern. A bearish engulfing pattern is a technical chart pattern that signals lower prices to come. The pattern consists of an up or blue candlestick followed by a large down or red candlestick that eclipses or engulfs the smaller up candle. The pattern can be important because it shows sellers have overtaken the buyers and are pushing the price more aggressively down than the buyers were able to push it up. Interpretation. Price action must show a clear uptrend when the bearish pattern appears. The large bearish candle shows that sellers are piling into the market aggressively, and this provides the initial bias for further downward momentum. Traders will then look for confirmation that the trend is indeed turning around by making use of indicators, levels of support and resistance, and subsequent price action that occurs after the engulfing pattern. Why are engulfing candles important for traders? Engulfing candles assist traders to spot reversals, indicate a strengthening trend, and assist traders with an exit signal. First, reversals. Spotting reversals are self-explanatory. It allows the trader to enter a trade at the best possible level and ride the trend to completion. Second, trend continuation. Traders can look to the engulfing pattern to support the continuation of the existing trend. For example, spotting a bullish engulfing pattern during an uptrend provides more conviction that the trend will continue. Third, exit strategy. The pattern can also be used as a signal to exit an existing trade if the trader holds a position in the existing trend which is coming to an end. A limitation of the engulfing candle can arise when the pattern turns out to be more of a retracement than a definite change in direction, but traders can look for subsequent price action to reduce the likelihood of this undesirable outcome. And now, how to trade engulfing pattern. Engulfing candles don't always have to appear at the end of a trend. When viewed within a strong trend, traders can glean information from the candle pattern pointing towards continued momentum in the direction of the existing trend. In this video, I will give you an easy 4-step process to trade engulfing pattern and how you can trade it for huge profits. You will also learn the characteristics that must be present to make it tradable. Knowing these things will help you maximize your profit potential and minimize your risk. So, let's get started. Step number 1. Isolate the trend. The first step in applying the engulfing candle trading strategy is to determine the dominant trend direction, and thus the direction you will trade in. An uptrend is defined by higher swinging highs and higher swinging lows in price. Prices move in waves, advancing, pulling back, and then advancing again. In an uptrend, the advancing waves are larger than the pullbacks lower, creating overall progress higher. During an uptrend, you should take only long positions, buying with the intention of selling later at a higher price. The downtrend is defined by lower swinging lows and lower swinging highs in price. In a downtrend, the declining waves are larger than the pullbacks higher, creating overall progress lower. During a downtrend, you should take only short positions, selling a borrowed asset with the intention of buying and returning it later at a lower price. Step number 2. Watch for an upward or downward pullback. Once the trend is established, wait for a pullback. If there is no trend, or it is unclear, don't utilize this strategy. Waiting for a pullback means you're getting advantageous pricing for the next wave of the trend when, and if, it unfolds. If the trend is down, watch for an upward pullback. The pullback should not rally above the high of the prior pullback, as this violates the rules of a downtrend. And if the trend is up, watch for a downward pullback. The pullback should not drop below the low of the prior pullback, as this violates the rules of an uptrend. A pullback should be composed of at least 2 price movements, indicating the price has actually corrected. Pullbacks may move in the opposite direction of the trend, or may just move sideways. Step number 3. Entering the trade. With the trend isolated, and a pullback occurring, wait for the engulfing candle strategy trade signal. During a downtrend, wait until a down candle engulfs an up candle. For an engulfing candle strategy signal during an uptrend, wait until an up candle engulfs a down candle. The most practical and widely used way to trade these bars is to simply place a pending entry order a few pips above the high of a bullish engulfing bar and a few pips below the low of a bearish engulfing bar. Once a trade is initiated using the engulfing candle strategy, the safest position for a stop loss is a few pips above the recent swing high for short positions and below the recent swing low for long positions. Step number 4. Exiting the trade. The engulfing candle that occurs after a pullback in an overall trend is designed to get you into a trade as the next wave of the trend is likely to unfold. However, it doesn't always. Trends can persist for a long time, or can fail quickly. Therefore, this method does not have a specific exit. A rule of thumb is to make sure your winners are at least 2 times as big as your losers. 5 times bigger is even better. Therefore, measure the distance between your entry point and where you place the stop loss. For example, if it is 40 cents, that is your risk. Your target price should be at least 2 times greater than that, or 80 cents. Therefore, hold the trade for at least an 80-cent gain to compensate yourself for the risk you've taken. If the trend threatens to reverse, by making a higher high and higher low during a downtrend and short trade, or by making a lower high and lower low during an uptrend and long trade, exit the trade. Using the engulfing indicator for trading. Essentially, the engulfing patterns show where the market pressure is concentrated. The engulfing indicator posts an upward pointing blue arrow when it identifies a bullish engulfing pattern and a red arrow pointing downward when it detects a bearish engulfing pattern. Therefore, your work is to identify the arrows and trade accordingly. The engulfing indicator relieves the trader of the hard work of identifying the pattern on the chart. It also directs investors whether to buy or sell by posting bullish and bearish arrows. You simply mount the indicator on the chart and it will identify the patterns for you. This should be simple enough. In this video, I've included a template with the system that you can simply upload to your chart and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Cautionary notes. First, the sign that trading the engulfing pattern is a bad idea was that we didn't have enough profit margins. Here is the example. Second, engulfing patterns won't occur after every pullback, which means potentially missed opportunities. To help avoid this, consider allowing multiple candles to create an engulfing pattern. For example, if after a pullback in an uptrend, it takes 2 up candles to engulf the prior down candle, consider this a valid signal of a shift in momentum back in the trending direction. Third, an engulfing candle strategy signal doesn't mean the trend will always resume. That is why a stop loss is mandatory. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.